Uh, I want to thank everyone for joining us today for part 4 of our Business 101 series. Today we will be discussing taxes, specifically how your businesses can be taxed, what you can deduct, things along those lines. Joining me today is Nick White. He heads up our bookkeeping department, and he'll be jumping in with some commentary, potentially asking some questions that he sees on his side of the industry, things like that. If you want to watch this webinar again, recommend it to a friend. It will be posted on our YouTube channel, and you can find it there. So the agenda today: how is my business taxed? What can I deduct? And then the big question I get is, how do I owe money? I get that one hopefully less often as time goes on, but I want to make sure that everyone's informed as we start our businesses together. So let's start with, how is my business taxed? It's important to know that there are different types of taxes. The most common one that you talk about with CPAs and that people worry about is income taxes. Income taxes are taxes you pay on income you earn as an individual, or in some circumstances as a business. There is also sales tax. Sales tax is assessed on products you sell. Sales tax is assessed different by different locations. Normally it's a state tax registration, and your tax rate depends on your location or the location of the sale. And then lastly, there's property and real estate taxes. Property and real estate taxes are on vehicles, sheds, land, houses, things like that. I will say that there are very limited tax mitigation strategies when it comes to sales tax, personal property taxes, and real estate taxes. Really, the only one that I can think of is if you pay your sales tax early enough, they will give you a discount. Nick, am I missing anything there? I think that's about it. The big one that people try to mitigate taxes for is income taxes.
Yeah, I think you covered it.
Okay, fantastic. So let's get into, how is my business taxed? My computer's frozen, so give me a moment. Let's try stopping sharing for a second. Here we go. So there are different entity types, which means businesses are taxed differently. The only business that pays income tax at the business level is a C corporation. Most people, unless you're registering in order to sell in the future or go on the open market or take a wide variety of investors, are not going to be a C corporation. But if you are, what you are stepping into is an entity level taxation of roughly 20% on your net income. That means your earnings less your expenses. And then if you need to distribute any money out to shareholders in the form of a dividend, which is how you would normally distribute money to shareholders, they are then going to be taxed based on their personal taxes, anywhere between 0, 15, or 20%, plus state income taxes. C corporations do not pay self-employment taxes. Self-employment taxes, for those of you who don't know, are, think of it as if you were an employee, you had FICA, Medicare taken out of your paycheck, and you paid your half. Self-employment taxes is simply both halves of that. So your employer also pays the same taxes you do on the wages that you were paid. So C corporations, no self-employment taxes, but they are subject to double taxation. Anything beyond that, the only way that you'll incur income taxes that you pay as an individual shareholder, dividends if you sell your stock in that C corporation, and that's really about it. S corporations, partnerships, single member LLCs, those are all flow through entities or taxed on your individual tax return. So S corporations and partnerships, they have separate tax returns. They do not pay income taxes at the corporate level. So just because your S corporation has earnings of $400,000 doesn't mean your S corporation will pay taxes on those earnings. You as a shareholder will pay taxes on those earnings based on the income that is allocated to you. That can be based on a variety of different things. I won't get into all that today. I think that's a little bit too far down the rabbit hole. The important distinction between S corporation and partnership, as we've discussed before, is one of them is subject to self-employment taxes, one of them is not. Partnerships subject to that 15% self-employment taxes, S corporations are not. Both flow through to the owner, where your individual taxes are paid there on the earnings from the company. Single member LLCs, those are on your 1040. Your 1040 is your personal income tax return. So there's different reporting requirements for all these, but I think the important concept to walk away from here is There are different taxes assessed on the different entities. Just because an S corporation isn't subject to self-employment tax does not mean it's the best for you in your particular circumstance. Once again, if you're considering which entity is right for you, one, talk to a CPA, or two, at least start with a single member LLC, in my opinion, and work your way from there. Normally, I don't think that you'll be questioning whether or not a C corporation is correct for you. Normally, whenever you're starting those ventures, you'll know. What's important to be considered is also your cash versus accrual. So what does that mean? Businesses are taxed normally on the cash basis, not always. So cash versus accrual would be if I incur liabilities. So if I incur a bunch of expenses that I haven't paid yet as a cash basis employer or as a cash basis taxpayer, I am not going to pay taxes on those earnings. I won't get to deduct anything that I've just accrued. I have to actually pay it. So money actually has to come in and leave your account in order for it to impact you as a cash basis taxpayer. Accrual basis taxpayers is based on when you incur expenses. So if you have incurred an audit fee, the person has performed an audit for you, but you haven't paid for it yet, you would still accrue it and you would still get credit for it on your taxes. So what does that mean in terms of choosing whether or not you should be cash versus accrual? If you have lots of receivables and low payables, I would recommend that you are a cash basis taxpayer most of the time. It means you'll defer paying income taxes. If you have lots of payables that you accrue and low receivables, it may be better for you to be an accrual basis taxpayer to accelerate those deductions. Nick, am I missing anything with those two concepts there?
No, I thought the explanation was great.
Thank you. And then lastly, I think what happens if I leave money in the company is a question I get all the time. Once again, your company is not incurring taxes. So whether or not you leave money in there does not matter. There are some exceptions regarding basis. Most of the time, that's not going to be a real factor to kind of come into play. So you are taxed based on the money your company earns, but you are taxed at an individual level. So whether or not you distribute, so let's say your company earns $400,000. And let's say you keep all that money in the company. And let's say you own that company by yourself. You will pay taxes on $400,000. Well, let's say you leave $200,000 in it, but you take the other $200,000 and you distribute it to yourself. You will pay taxes on $400,000. Let's say you pay yourself a salary of $200,000, but you leave $200,000 in the company. You will be taxed on $400,000, plus you'll pay self-employment taxes for the wages that you're paying yourself. So there is no tricky way around paying yourself versus not paying yourself, leaving money in the company that helps with tax avoidance. At the end of the day, the money that the company earns is what you're going to be taxed on. Once again, it is not the company that is paying the taxes, but rather the individual shareholders, partners, single member LLCs. The owners of those are who incurs the tax liability. It's generated by the partnership, the S corporation, the single member LLC, and paid by the owner. Nick, anything I should clarify or expand on there?
Yeah, quick question. If I was an S Corp and paid myself a wage, wouldn't that save me some taxes on the self-employment tax?
Sure. So the main strategy I'll say for becoming an S corporation is to avoid self-employment taxes, or that's a big reason for becoming it is they're not subject to self-employment taxes. You are required as an S corporation owner to pay yourself a salary commensurate with your position. So let's say I started my CPA firm and it was a single member S corporation. It would be unreasonable to say that my salary as a full-time CPA was $7,500 per year. It is not commensurate with the work I'm performing. So you're paying both sides of self-employment taxes because you're paying your employee side as being an employee of the company. You're also paying the employer side on the piece that you pay yourself the salary on. Anything in excess of that, earnings in the company, not subject to self-employment taxes. So that's a good question. And then I think one thing I should probably address more is why would I not be an S corporation? It sounds like it's the most tax beneficial. There are reasons not to, specifically if you're getting into investments such as real estate. S corporations don't allow you to have basis as a shareholder, which means if you take a large loan out to finance your business and it's running at a loss, you're not able to deduct that on your tax return. So that's one of the main arguments against it. Or if you are going to have a multi-member company and people aren't going to be taking distributions equally, that's not going to work as an S corporation. There's only one type of shareholder allowed, and everyone is required to receive distributions equal to their percentage of ownership in the company. So the next question I get is, what can I deduct? And if you think in terms of what is a reasonable deduction for business, do I need this to run my business? If the answer is yes, then yes, you're going to be able to deduct it. Some things that people oftentimes leave out are vehicles. So if you are thinking you need a vehicle for your business, I could spend an entire webinar describing the different types of deductions for your business that are allowed, whether or not you can write off the whole vehicle, whether or not you should lease it, whether or not you should just take the mileage rate. I would say if you have a vehicle that you are using in your business, what's important is that you reach out to our office to discuss, am I deducting this correctly? I'm thinking of buying a new one. What type of vehicle should I buy? How does that impact my business? Charity versus advertising. So charity is not always going to be a deduction allowed for business. What happens is that flows through to the shareholder partner, whoever. So let's say I have $1,000 of charitable contributions in my business. I don't get to deduct that from my taxable income as a business. What happens instead is it goes as a deduction for a shareholder. But if I, as a shareholder, don't itemize, I get no benefit out of it. So whenever you're doing things that could be considered charity or advertising. So for example, if you are, maybe you are sponsoring a golf tournament, it may be more beneficial to think of that as advertising, which is a actual write-off for a business that's allowed versus considering it charity. So if you are participating in some of those blended activities, once again, give us a call. Let's talk through, is it charity, is it advertising? Does it really matter how you deduct it either way in your particular circumstance? Because sometimes it will. Meals versus entertainment. So Nick, do you want to kind of go into the meals versus entertainment, which one is which, kind of differentiating between the two, and I'll go into how they're deductible in the current tax law.
Yeah, so meals are kind of self-explanatory. When it comes to meals, it's where you'll potentially take a client out or a customer out to a lunch, dinner. Entertainment is more on the lines of going to see a movie, playing golf, that sort of thing.
Yeah, I think the most common example, I'll pretend I'm a client here. I went out to a ball game and I brought a client the other day. Well, we got hot dogs. Is it the whole thing considered a meal? The answer is no. If you can specifically allocate the portion of your ticket that was associated with food, that piece can be considered a meal. Anything else is going to be considered entertainment. There's specific rules in terms of using luxury boxes, things like that make them not deductible. But the important thing to remember is meals are deductible, entertainment is not deductible, and meals under the current tax law next year are going to be 100% deductible. Now, why that sort of reversal is a great question. Why do they go from being able to deduct it 50% versus 100? Well, if you look at the pandemic this last year, who was mostly impacted by restaurant industries, service industries? The IRS is providing an incentive to other businesses to use restaurants and basically pump more money into that industry to help kind of cope with the impact that they had from COVID. That's my opinion on it. I haven't read that specifically anywhere in the law, but I think that's probably the reasoning behind that. Another one that's commonly overlooked is the business use of home. So if you're operating an office out of your home, there are methods available to you in terms of how you can deduct that. So there's a simplified method based on your square footage. There's a complex methods based on your square footage multiplied by the expenses you're incurring in your house. I think what's important to remember is that a business use of home is an allowable deduction. And what you really need to explore whenever you're taking that is it actually a deduction for me? So it needs to be a separate space specifically used for business. So I, for example, live in an apartment. I don't have a separate place for my office. So my desk is technically sitting in a common living area. I am not allowed to use that as a business use of home as a deduction if I own my own business. It needs to be a separate room specifically for that use. I'll also say it was it's over the course of the years, it's something that's audited more and more frequently. I don't think it's probably as common with the simplified method because the deduction for that is much lower versus the complex method. You can really run a lot of things through there, whether or not it's actually beneficial for you as a homeowner. It just depends on your particular circumstance. I think depreciation I included on this list because I think it's something that's commonly misunderstood. So what is depreciation? Depreciation is the write-off of a long-term asset over a period of time. So if I buy a shed, I don't get to write off a shed in its entirety in the first year under many circumstances. There are exceptions to that, but most of the time think of if this is going to be in place over a long period of time, the IRS normally wants you to write that off over a period of time over its useful life because the IRS wants you to incur expenses as they realistically happen. And it is not necessarily realistic that your shed uses its entirety of its useful life in the first year. Why does it exist? It exists to, I assume it exists because the IRS, once again, wants you to reflect a realistic life of the assets you're putting in place. If this didn't exist, people could buy real estate and write it off in its entirety in the first year, in which case I'm sure real estate would become a more common investing activity. So the IRS has depreciation in place in order to reflect the actual useful lives of assets. Nick, anything I'm kind of missing on there or was unclear on?
Oh, I think the explanations were great.
Okay. R&D credits. Nick is, I would say, the expert on this in this case. Nick, can you explain kind of what R&D credits are?
Yeah.
And then also maybe people commonly don't think that they apply when, or don't necessarily think that they are available to them when in fact they could be.
Oh yeah, definitely. So the research and development tax credit exists to incentivize businesses to advance current technology or develop a new product. There are specific requirements though to qualify for the research and development tax credit, and the main ones are you have to come up with a new or improved business component. There has to be process of experimentation. It has to be technological in nature, which means there has to be, engineering would be a great example to that. And then what all goes into that, you can include, contractor expenses. So if you're outsourcing an engineering firm to be working on this new component that you're developing, that they would qualify. If you have engineers on your staff and you're paying a W-2 wage, that would qualify. There's a lot of things that go into research and development tax credit. It's just certainly not engineering. And if you have any questions on that, feel free to reach out to us. Jordan, is there anything?
Yeah, so a couple things. There are firms, if you even if you don't think it's a possibility, hopefully it comes up in conversation with us to where we can explore what your business does to where maybe you qualify for an R&D credit. There are firms out there who are happy to have the conversation to see if you do qualify free of charge. It's worth your time every time, in my opinion. It is free money. Most of those firms guarantee the credit to where even if the IRS were to overturn it, you wouldn't be at risk. And along those same lines, the IRS is focusing in more on R&D credits. So people who are self-certifying are need to make sure that they have good documentation in place because the likelihood of you being audited for it is increasing.
Yeah, and to add on that, the IRS is actually going to require that the due diligence is submitted along with the tax return starting in 2022. So they're not wanting just the credit to be claimed on the return and move on. They want to make sure everyone's doing their homework on it.
Yeah, that's a good point. And then the last piece of our segment today is why do I owe money? And I think the real question behind why do I owe money is I didn't necessarily net positive cash flow. How do I owe taxes? I think that's the real thing that pushes that question out most of the time. And whenever you think about that, you need to think about your taxable income versus your cash outflows and how they can be different. So once again, we talked about depreciation before. So if I purchased a lot of fixed assets this year and I used cash, I'm not necessarily going to be cash flow positive. But if I'm forced to depreciate those over a period longer than 1 year, it's very likely that my taxable income will be higher than my net cash flow for the year. Another thing is loan payments. Loan payments are not a deduction. You can deduct the interest portion of them, but the payment itself is not going to be a deduction. So if you are heavily debt leveraged, you may be spending a lot of money on debt payments. and that's going to mean a lot of cash outflow, but that doesn't mean that your taxable income is negative. So where are you going to see that a lot? Real estate. Partner and shareholder distribution. So if you take the money out of the company, once again, that is not a deduction. If you kind of go back to our second slide there, taking money out of the company is not a deduction. So just because I don't have any money left over in the company doesn't mean I won't have taxable income. Once again, in most companies, that taxable income is going to be paid by the shareholders. So they should have the money available to them to pay the tax liability. But just because there's no cash left in the company doesn't mean that there wasn't positive net income. And then once again, back to accrual versus cash accounting. I show that I have received a lot of cash this year, but I didn't actually get it taxed. Well, what if I'm an accrual basis taxpayer and I accrued it all the year before? I paid the taxes in that year, and then I didn't have any left this year. So differences in your accounting, in your accrual versus cash accounting versus your cash receipts can be a factor that leads to the fact that your taxable income isn't necessarily what you would be expecting. And then lastly, I would say this is probably the biggest one, especially for first-time business owners, newer business owners, is they don't realize that they have to pay taxes as they go. So if I start a Schedule C this year, a single member LLC, and I make $100,000 and I just pocket that cash like I would as an employee, I'm going to get to the end of the year and I'm going to owe $35,000. Why is that? Because I have paid nothing into the federal government, not my self-employment taxes, not my income taxes. And how do you avoid that? You can do estimated tax payments on a quarterly basis to both federal and state governments. In fact, I recommend you do. If you're starting a new business, I absolutely recommend that you reach out to us to see if you have a tax liability. That way, there are no large surprises whenever it comes time to file your taxes. For a variety of reasons, but especially because working capital is especially important for businesses. You need to know what you are operating on, and a surprise tax bill doesn't help anyone operate their business. Nick, Catherine, any outstanding questions or anything that I've missed?
It doesn't look like we have any.
Fantastic. Well, I want to thank everyone for joining us. Next week, Nick and I will be discussing your business is running. Now, what should you be doing to improve it? So looking forward to seeing everyone then. Thank you so much.